Hi, Jonathan York from IRG BOP. Increased volatility towards the end of last week was caused by the nervousness regarding the so-called pig economies out of Europe, which is Portugal, Ireland, Greece and Spain, and there are increased debt concerns over the ability to be able to fund them going forward. It did cause some nervousness in the equity markets, and many nervous investors did look to exit positions. If you now wind forward to a couple of days, we've seen renewed talk coming out of the Eurozone now that Greece will more than likely receive some form of aid package from within the EU, and the markets have rallied strongly on the back of it. So I think we've just got to be very careful of the sort of speed bumps that are going to be placed in the road to this on this market recovery, and not look to get too carried away on the first piece of negative news that comes through. So what does all this mean for markets? Well, obviously you will see an increase in volatility. We've seen some quite big moves in some of the currencies. The US dollar strengthened, the Euro's obviously weakened, the New Zealand dollar's weakened, and also the Australian dollar's weakened. Interestingly though, we haven't seen too much an uptick so far in gold, which you'd normally anticipate if you really were concerned about a major sort of meltdown of the financial system. And indeed, many analysts are still forecasting a pretty major rally for equities over the course of the next sort of 12 months. With some commentators looking to comparisons back to 2004 for the emerging markets, and if you go to the IRG BOP website, there's a good article there in regard to the emerging markets, where some, as the analysts, are forecasting a sort of 30 to 40% increase in their equity markets over the next sort of 10 months. Elsewhere, we would see in the news that Australia is going to remove the government guarantee for the wholesale funding. Now, this is different to the retail deposit scheme guarantee we have here in New Zealand. Certainly in Australia, that is still in operation as well on the retail team, but they're just looking to remove the wholesale government guarantee. Now, again, this should be viewed as positive and not negative. The reason why it's positive is the fact that it wouldn't have been removed unless the market had significantly improved in its market conditions, which then enables the central bank to be able to remove this facility. So again, that is a very positive move for the market, and does demonstrate that the markets are recovering in a pretty major way. On the domestic market here, just starting the reporting season, telecom will be the big news this week, and it'll be interesting to see their dividend policy if that is continued. On current prices, if they continue with their dividend policy as they have over the last couple of years, you're getting a dividend yield close to 10%. So that may well be attractive for some income generating portfolios. So watch those earnings that will be reported on Thursday. Also, we still have a short period of time before the Auckland Airport rights announcement has to be sent back to them for acceptance. Again, it's a pretty heavily discounted rights issue, $1.65 as opposed to around $1.90 for the shares. So if you do need any information on that, give us a call on 0800 867 323. Risk disclosure available on request. Or call us on 0800 867 323 or go to the website irgbop.co.nz. Lots of interesting articles and links to various investment opportunities, and look forward to speaking to you soon. Thank you.